How perpetual futures derivatives work. In traditional derivatives markets, every futures contract has an expiry date. On that date, positions settle and the contract ends. Perpetual futures flip this, they never expire. Traders can hold positions indefinitely without rollover, without settlement dates, and without ever taking or making physical delivery. Instead, a mechanism called the funding rate keeps the contract price anchored to the underlying asset. Here's how it works. Chapter 1: The problem with expiring contracts. Traditional futures create artificial pressure points. Contracts expiring in December, January, and March each get rushed buying and selling in their final days as traders close or roll positions. This creates price volatility unrelated to the underlying asset. It's just technical expiry pressure. If you're a trader holding a position longer than a single contract's duration, you have to roll, sell your current contract and buy the next one. Each roll incurs costs and creates exposure to the price gap between contracts. For institutions managing large directional positions, this friction adds up. Chapter 2: How perpetuals use the funding rate. Perpetual futures solve this with an ingenious mechanism. Because there's no expiry date, the futures price can drift away from the actual spot price of the underlying asset. If everyone is bullish and buying perpetuals, the perpetual price might be 10% higher than the spot price. That gap is the problem perpetuals solve with the funding rate. Every 8 hours, traders on the winning side of the gap pay traders on the losing side. If perpetuals are trading above spot, long positions pay shorts. If perpetuals trade below spot, shorts pay longs. This payment mechanism automatically corrects the gap by making one side more expensive to hold, which pushes prices back toward equilibrium. The funding rate is just the market automatically incentivizing reversion. Chapter 3: Where perpetuals dominate and why. Perpetual futures were invented by crypto exchanges and now dominate crypto derivatives trading. They become the primary tool for leveraged speculation on Bitcoin and Ethereum. The simplicity is huge. Hold a position for days, weeks, or months without managing contract rollovers. No expiry dates means no forced settlement days, just a position you manage until you close it. The leverage is also significant and the risks are real. Positions can be liquidated instantly if price moves against you. The funding rate compounds costs for traders holding strong directional bets in trending markets. But for active traders, the mechanic solved a genuine friction point in derivatives trading. To wrap up, perpetual futures represent a genuinely elegant financial innovation. By removing the expiry date and replacing forced settlement with a continuous funding mechanism, perpetuals let traders hold leveraged positions indefinitely. It started in crypto, but the mechanic is spreading to traditional markets too. The elegance of the mechanism is matched by the risks of leverage, but as a tool for managing directional exposure over extended periods, perpetuals are hard to beat. This has been a mini Leviathan production. If you enjoyed it, check out our other videos. See you in the next one.